Okay, hello everyone. I hope you can hear me loud and clear. Uh, Welcome to the Power Trading Workshop brought to you by FX Street. And my name is John O'Donnell. And there's my email address there if anyone would like to email me after the event for any reason whatsoever. It's John, John, at tradingacademy.com. And I want to thank FX Street for the opportunity to make a presentation today. I assume most of you know who Online Trading Academy is. If not, you certainly might want to visit our website. Do we have any Online Trading Academy graduates in our audience today? And by the way, let me know where you all are located. What cities are you all located? We probably have quite a few cities and countries represented in our audience here today. So give me a little bit of feedback as we go through this, okay? Well, at least we've got D.C. and Moscow covered, and Jakarta, that's amazing. Toronto, wonderful. Glad to see all of you here today. The important point I think I want to get across today in my message, and some of you have, and I would encourage you, for those of you who haven't heard my presentations at FX Street before, to go back to the FX Street archive. I think there are 3 other presentations archived there from various periods of time. This will be the 4th presentation I've made to this community. And there's a lot of information. The stuff I'm going to show you today is remarkably similar to the other theme, but I've updated some of my slides. But, I really believe that under no circumstances should you allow the market decline paralyze you. You need to get into action and create trading plans that will adapt and be adaptive to the economic conditions that we're in today. I'd like to believe that one of the highest value-added services that we offer at Online Trading Academy, and I'll tell you a little bit about us before I leave today, is that we help active traders create trading plans to protect and grow your capital. And as most of you know, that if you've done any trading at all, trading is about risk management first and foremost. We're going to go through some pretty serious continued economic challenges like we had in 2008. Those are going to continue in 2009. And we'll talk a little bit today about why that is and what you can do about it. The title of my presentation today is 2009 Economic Forecasts. I could have subtitled my talk, Perception versus Reality in the Globalization 3.0 Credit Bubble Deleveraging Era. That's what's uniquely different. You and I have lived, certainly since, even Ronald Reagan's election, way back in the early 1980s, we've lived in a world where global economies, both governments and the private sector, have had available to them cheap liberal credit, and the world has gone through a tremendous leveraging process. Virtually every institution you can think of has gone through massive amounts of leveraging, and we're going to look at some of that data today. But we are now going through a deleveraging process, and I think that means we have to, it's going to impact all asset classes: equities, options, forex, commodities. The dramatic volatile price change phenomenon that you and I have been witnessing, certainly through 2008, is a symptom of the deleveraging process. And so I want to address that today and see if I can help you figure out how to adapt and adjust your trading plan for this continued deleveraging process that will certainly run through 2009. It very well may run through the rest of this decade. We can debate how long the deleveraging process is going to go on, and we can debate the symptoms that it will create in price change in various financial asset classes. But the evidence, to me, is very, very clear of why we're in this condition. Now, you and I have been reading about tremendous bailouts. We have been going through, on the screen are some of the biggest branded financial services companies in the world. And central banks across the world are going through a coordinated effort to re-stimulate economies, making available cheap liberal credit. What's very interesting, we keep hearing in the press that Congress in the United States is disappointed after buying preferred shares in various banks in America, that the banks aren't lending the money. Banks, are not supposed to lend capital. When you put capital into a bank, the capital cushion is there. The banks are supposed to lend deposits. Banks are supposed to have a capital cushion which allows them some breathing room for losses on loans to lend out deposit capital. But it's not surprising to me that Bank of America, Citibank, Goldman Sachs, J.P. Morgan, some of these other financial institutions, Morgan Stanley, Merrill Lynch, etc., are not lending out capital, is simply because they need a capital cushion. They're fearful of lending. See, what a lot of people forget in a credit environment, and capitalism is driven with credit. The bottom line is, we'll take a look at some data here in a moment about how aggressive banks have been in lending as a percent of GDP, why the credit bubble formed, why the credit bubble burst, and why we're going through this deleveraging process. And I think once you look at the data, you'll have a much clearer picture on why this could happen for a long period of time. But who's going to be next? Are we going to now bail out our automobile industry? I don't know where you draw the line in the sand. Are we turning in America from pure, unadulterated capitalism, or are we turning to an environment where we're going to have a new aggressive bout of socialism, where we socialize risk? And I'm very concerned about that. I'm not only concerned about it in that it is a trend in America, but it very well may become a global trend unless someone gets their arms around it. I don't know where we draw the line in the sand. I mean, is it, capitalism and socialism are two uniquely different systems. In capitalism, you have the right to win and you have the right to fail. I remember when I did a grand opening for Online Trading Academy's Detroit's office, I went and visited the Henry Ford Museum, and I made note that at least the guy giving us the tour of that incredible facility was in, I believe it was around 1920. There were, maybe it's 1915, around 1915, we will have, I believe there was 15 million automobiles on the road, and 75% of them were Fords. But yet, Mr. Ford there were over 400 automobile companies in America. 397 of them have gone bankrupt. And we didn't need to bail those 397 companies out. And I'll be honest with you, I don't really believe that we should be bailing out Ford, GM, and Chrysler either. So we're going through a process now of trying to socialize risk, privatize profits, and socialize risk. And I don't know how far this is going to go. I don't know how many industries are ultimately going to qualify for this. But I want to show you a very interesting chart. The chart you have in front of the Dow Jones Industrial Average over the last 100 years. And I'm going to post a series of, this goes from roughly 1902 through 2006. So this is over 100 years of pricing via the Dow Jones Industrial Average. I would call this the EKG of the American economy. Now, as you can see, as we scroll through here, we've had a tremendous amount of volatility. If this were a road, and you were riding a bicycle along this road, you can see it was not a smooth ride to the top. But I think visually looking at all of the challenges we faced, going from even the Great Depression of the 1930s through Pearl Harbor, the Korean conflict, the Cuban Missile Crisis, Vietnam War, the assassination of President Kennedy, the crash of '87, etc., even the attempted impeachment of various presidents, and of course, who can forget World War II? I should never leave that out. But you can see that our economy has grown through a tremendous amount of change. And the thesis of my presentation is that in America, no matter what is thrown at us, we're a very resilient culture. We have faced much adversity, significantly bigger than we're facing now as we go through a deleveraging process. But I want you to keep in perspective that America is a great country. We got our challenges. We're not perfect. There are no perfect countries. We make mistakes, but we adapt rather quickly, and we generally get through them. And I'm confident that we will get through this deleveraging mess that I'm about to describe. Although, that being said, I believe there are going to be some traders, investors, who are not prepared for what's coming in 2009 and 2010, and they're going to get hurt. They're financially going to get hurt. Many of their 401ks have already become 201ks. My job is to help and you prevent them from becoming 101ks. Now, let's go forward here a bit and talk about what's been the root cause of that challenge. We've had a growing economy. This is a chart compliments of our friend at Elliott Wave. And it shows you a 5-wave, 1, 2, 3, 4, 5, and then an A, B, and now C wave of a 34-year price trend. And this arrow right here is June 19th of 2008. And I was in London on June 19th. At that day, the Dow was 12,638. And the statement was made that if we break this 34-year price trend, which started way back here in December of '74, Reagan was elected here in the fall of 1982, that we were in for a precipitous decline. And I want to show you, and we're going to compare this. This is in nominal terms. This is the Dow price in dollars in nominal terms. We're going to adjust that in a moment and look at it from a different perspective altogether, which is what we call here at Online Trading Academy the real Dow. But there are many pundits that are forecasting if we were to break this 34-year price trend, and I believe it's quite significant, is that we can have an absolute free fall in the market. That's not necessarily our forecast here today, but there are some very credible analysts who are forecasting the possibility and probability of a very, very substantial decline of the market. Now, we're going to look at this in just a moment. But let's first of all talk about what caused this great bubble boom in this 34-year bull market. And from our perspective, what caused that bubble boom was the availability of cheap liberal credit. And this is the total credit market debt in all sectors as a percent of GDP. And credit's important. A capitalistic system runs on credit. But there's two components of a credit market. There's a willing lender, who generally like to be repaid, and then there's a willing borrower, who has a social mood to borrow, put credit to work. And I believe most people that borrow money have an intent to repay it. There are some that commit loan fraud, where they have no intent whatsoever to repay the loan. But the vast, vast majority of borrowers, be they be federal borrowers, state borrowers, municipal borrowers, corporate borrowers, or individuals, have an intent to repay the loan. But recognize what drove our economy in the 1920s, and by the way, the biggest bubble boom in the history of America, both in real estate and the stock market, was in the 1920s, was the availability of cheap liberal credit. What created what we call the Great Depression was that this credit bubble burst in the 1930s. And take a look at where debt as a percent of GDP went. After the bubble burst in the 1930s, debt as a percent of GDP goes all the way back to the long-term average, which is about 120 to 130% of GDP across this line right here. And we had significant events that took place. We financed World War II. We financed the Korean War. We financed Vietnam. These were huge deficit years of deficit spending. And then, of course, Reagan was elected in this era right here, around 1982. And we went into this big bubble boom, which financed this entire stock market move right here, from 4 to 5. Now, we're right here. Debt as a percent of GDP today is over 325% of GDP today. Now, this does not include the unfunded liabilities of Medicare and Social Security. If I were to throw those in, debt as a percent of GDP is probably up in the vicinity of about 600% of GDP. Now, could this credit bubble burst? And my thesis here today is that the deleveraging process starts right here, and that debt as a percent of GDP is going to start falling, and this is the problem that we have. This is the fundamental challenge that we face today, in that we borrow about we Americans borrow about $2.5 billion a day from the global producers, who recycle their savings to America. Capitalism needs capital. You can't have capitalism without capital. There's basically two forms of capital. There's debt, and there's equity. Now, the personal savings rate of America in orange has precipitously declined. This is from 1970 through 2006, actually 2007. You can see right here, in 1975 and in the mid-'80s, that on the right scale is our personal savings rate was up here in the vicinity of 12% of GDP. And it's precipitously declined, and we have been in a long-term bear market in formation of savings in America. It, matter of fact, got down into a negative number, and it's now ticked back up here recently. And this ticking back up process is a symptom of the deleveraging process. Now, you can see in the blue line, starting in 1970, is that debt as a percent of GDP on the left scale has gone from 150% of GDP to 300% of GDP. So our process of deleveraging is starting right here. We're going to go through a period of dramatic deleveraging. Now, this is what this picture is going to look like. And this is probably what it's going to look like, certainly through, we believe, 2012. We think it's going to take through 2009 through 2012, and we can debate when that end point might be, but we think we're going to see a trend toward deleveraging, which is a contraction of the global credit bubble. Now, the central banks of the world are going to attempt to delever the process on an orderly basis. But keep in mind there are two forms of deleveraging. There's an involuntary form of people who deleverage, and these are people that are going through foreclosure on corporate lines of credit, both voluntarily and involuntarily. And there are people that are losing their homes in America. It's estimated that about 2 million people have already lost their homes in America through the foreclosure process. There was a report that came out by, I believe it was Credit Suisse this week, that talks about the possibility of another 10 million homes going into foreclosure. This is a massive deleveraging process we have never seen before, including all the way back to the 1930s. Now, the chart you're looking at in front of you is a very important chart. This is just bank credit as a percent of GDP. There are multiple forms of credit. There's federal government credit that's issued in the credit market. There's municipal credit. There's states like California that issue credit. There are private debentures that get underwritten by investment bankers. But this is just bank credit. This is primarily things like mortgages. This is primarily things like credit card receivables, automobile receivables. This is just bank credit as a percent of GDP. And what does that profile look like? Well, this picture is from 1950 and forecasting through 2015. The average bank credit as a percent of GDP over that previous chart I showed you, where total credit profile was over 300, grew to over 300% of GDP. But the average is about 44% of GDP, and that's this red line right here. This is the average. It's about 44% of GDP. Now, this is where we grew in 2008. And what we started in 2008 was a precipitous decline of the deleveraging process. And our forecast is it's headed back to the average. We're going to go from roughly 66% of GDP down to back to and probably exceed 44% of GDP because it generally overshoots. It's called, in technical analysis, reversion to the mean. And I think this is a very conservative, realistic projection on what you and I are going to see in the global economies. Now, this is just America, but I believe we're also going to see this trend in a coordinated effort by central banks across the world to attempt to have an orderly process of the deleveraging process. Now, this is going to put a lot of stress on a lot of markets, and we're already seeing symptoms of what this will create in declining asset prices. Now, let's go back and take a look at this Dow Jones Industrial Average one more time. The Dow Jones Industrial Average, as you can see from what I'm about to put on your screen, has had a tremendous change over time. Matter of fact, I'm forecasting going forward, we're going to see an accelerated rate of change as companies deleverage. You're going to see many mergers and acquisitions. You're going to see consolidation in various sectors. And you're going to see some companies that will absolutely disappear. Now, we're already starting to see this aggressively in the financial services space, aren't we? The financial services space globally is seeing bank mergers everywhere. It's estimated in America by the time this process is finished, we very well may consolidate over 2,000 of our banks. It's also estimated we're going to see a lot of consolidation in the automobile industry. Again, some of this is going to be voluntary. Some of this is going to be done involuntary. You know, bankruptcy is a very important process in a capitalistic system. It allows the ability to convert creditor debt into equity. Generally, many cases, a new class of equity. But it's a scavenger process. It's a consolidation process. It is a process that allows us, bankruptcy, to weed out inefficient producers in a capitalistic system. Many companies have been reorganized and survived and prospered because of bankruptcy. It's not a court of liquidation unless liquidation is necessary. Evidence of that is in this chart I'm showing you right now. This is how the Dow Jones Industrial Average, the components of the Dow, have changed over 100 years. Now, this process is going to continue. I happen to believe it's going to accelerate between now and 2012. And I believe the rate of change that you're comfortable with, you're going to become uncomfortable with as this process consolidates. So let's take a look at the Dow. This is a very important chart in that it takes the Dow Jones Industrial Average as priced in nominal terms and divides it by the price of gold. In other words, this is an invisible crash of the real Dow. Now, this is the real Dow, not the nominal Dow. Now, why are we using, in other words, we're taking the nominal Dow and dividing it by the price of gold, the nominal price of gold. And we're putting the next tick on that chart as time goes on. In this example, you can see that the Dow, the real Dow, peaked back in late 1999, certainly very early part of 2000, and it's down and collapsed over 72%. And it's continuing to collapse. You know, today, how would you do this process? And my recommendation to you is, if you want to keep track of this, is every Friday, take the nominal Dow and divide it by the nominal price of gold, and you put the next tick on this chart and follow it. I think it's a much clearer picture of the value of the Dow Jones Industrial Average. Now, this was the real bull market, and this is a real bear market. And ladies and gentlemen, the real Dow, as forecasted on this chart starting in 2000, tells us that the deleveraging process started way back in 2000. So we're 8 years into the deleveraging process. Now, it's starting to accelerate because of the banks and in the financial sector. Now, let's take a look at this from a different perspective. If I take the nominal Dow in blue and I lay over it what I call the constant dollar Dow, and this is the Dow Jones Industrial Average multiplied by the dollar trade-weighted index, you can see that there is a big gap between your perception and reality. Your perception is this is the valuation of the Dow. Reality is in red. This is the real valuation of the Dow as measured by the dollar trade-weighted index. And in the previous chart, if I were to lay a third chart over the top of this, which is the real Dow, which is the Dow divided by the price of gold, it's even going to look more ugly. Now, why am I using gold as my denominator? What is gold? Well, the reason we like gold as our denominator, and I could use any denominator. I could use copper, I could use milk, I could use oil, I could use the CRB index, I could use anything. I choose to use gold. And why do we want to use gold? Is because gold is a global currency that no central bank can print. It has acted both as a medium of exchange and a store of value for over 3,000 years. There's no paper currency that's held up to gold as a store of value. Now, this has been the purchasing power of the U.S. dollar going back over 200 years. And in red here is when our dollar was backed by gold, and the dotted line is when it was not backed by any tangible asset at all. In other words, we had what is known as a fiat currency. And you can see that the purchasing power parity of the U.S. dollar has gone from little over $1 down today to about 7 cents. Okay? That's a precipitous decline in its primary function, which is to be a store of value. Now, let's take a look at this over time. This is, and we've been talking about this in Online Trading Academy, using the Dow Gold Index as a primary indicator of valuation, simply because we trust gold to act as its role as a global currency, again, that no central bank can print, and give us a much clearer picture that, in fact, we are in a secular bear market. We've had, this is the Dow Jones Industrial Average divided by the price of gold, and you can see in 2000 that it peaked out right at about 44 ounces of gold 44 ounces of gold to buy 1 unit of the Dow. And we've had this remarkable secular bear market, and today it's going to take roughly what? Well, a little over 10 ounces of gold to buy the Dow. In other words, the way you would do that today is just assume the Dow today is at approximately 8,200, and let's assume that gold today is approximately $830 an ounce. You're going to take 830 and divide it into roughly 8,200, and you're going to put the next tick on this chart. Now, this is another important chart that I like, that I've used for many, many years. It's from 1800 to 2000. And again, I don't want you to look at gold as just a precious metal. I want you to look at gold as real money. I want you to look at euros and pound sterlings and dollars and yen as fiat currencies that have a convertible rate into real money. That's the role of gold. And that's why we continue to use, you can buy units of gold in virtually every free trading currency in the world. And there is a ratio of exchange. But take a look at this. This is 200 years of the Dow gold ratio. Again, taking the nominal Dow divided by the nominal price of gold and putting the next tick on the chart. I'm going from 1800 through 2000. It's showing me in this channel, relatively speaking, when stocks were overvalued relative to the price of gold. So at the top of the channel up here, I'm looking for periods of time of relative valuation. And all valuations are relative. Okay? Take a look at this. Stocks are high, gold is low. Stocks are high, gold is low. In this environment on the bottom of the channel, we see an environment where stocks are undervalued relative to gold. In other words, stocks, the Dow is low compared to gold being overpriced in this channel over time. Okay? And let's take a look at just the last 80 years. This is from 1928 through 2008, the Dow Gold Index. And again, I think it very clearly shows us the macroeconomic moves of the Dow over time as valued in gold. Note in roughly 1928-29 era, it took approximately 17 ounces of gold to buy the Dow. This was a bear market. This was a bull market coming out of that bear market. This is a real bull market coming out of the bottom of the Great Depression. This is a real bear market starting right here in 1966, all the way through Reagan's election, and then we have that credit bubble form, and this is a real bull market. And of course, starting the end of 1999 into 2000, we have the stock market crash in real terms, and we've gone from roughly 44 ounces of gold all the way back to this red line. And what this red line is the average. And that average is about 12 ounces of gold. Remarkable. Here's the gold price divided by the crude oil. In other words, how many barrels of oil does it take to buy an ounce of gold? And if you think about it, a barrel of oil is nothing but a fixed amount of BTUs of energy. Gold being a global currency, oil being a global commodity in demand, it's asking in real money how many units of BTUs of energy does it take to buy 1 unit of real money? And this is how this has fluctuated since 1990. So I think it's a very important principle that you should learn, take away. It's pretty simple for you to do. Every Friday, what I recommend you do, if you want to get your finger on this pulse, again, is take the Dow divided by the price of gold and put the next tick on that chart. And take the price of gold and divide it by the price of oil and put the next tick on this chart. And I think you will have a beautiful barometer to measure change. Now let's talk about consumer confidence. Consumer confidence is plummeting. We have some of the lowest numbers. The conference board is showing us some of the lowest numbers of consumer confidence. We haven't seen these levels really since 1967. Now, you can imagine that consumer confidence drives consumption. When people feel good, they buy more stuff. When people don't feel good, maybe they don't feel good about their job, maybe they don't feel good about their source of income, maybe they don't feel good about the economy, maybe they're seeing more foreclosure signs go up in their neighborhood that makes them nervous about the value of the equity in their home, they're going to slow their consumption. They're going to use less credit. They might even start saving money. Oh, wow. This is going to be a tremendous drag on the economy. There's something in economics known as the velocity of money. The equation that economists have shown us literally since Paul Samuelson 101 Guns and Butter Economics is that GDP is equal to the money supply times the velocity of money. In other words, how often does the money turn over? Think about the money that you have, the discretionary income that you have. How frequent does that capital turn over in an economy? The average, going back from 1900 through 2008, has been about 1.67 along this black line here. This is where the velocity of money went back in 1932, 1.17, the bottom of the Great Depression. And this is where it went in 1946, 1.15, coming out of World War II. This is where we went in 1997, and this downtrend that you're seeing right here, this is the deleveraging process. Consumption is 70% of our GDP. People are going to Starbucks less frequently. People are going to various restaurants less frequently. And when they go there, they're buying less units of goods and services. So the velocity of money is slowing. The demand for credit is slowing. And the economy is slowing precipitously. And we're going through this period of deflation. Now, what evidence do I have that this is global? I want you to go to the BalticExchange.com. The Baltic Exchange has been in London and operating since 1733. And they publish a freight index known as the BDI, the Baltic Dry Index. This is the average price for bulk freight. It's primarily bulk commodity goods, coal, soybeans, corn, iron ore. It's not wet goods. And the Baltic Dry Index has collapsed over 93%, which tells me that the demand to produce and ship goods globally from country A to country B and move across an ocean is telling us that the global economy is slowing. The demand for export trade finance is slowing. This, again, is part of the deleveraging process. Now, we're seeing the Fed precipitously lower interest rates. The Fed's run out about horsepower to monetize debt and lower interest rates. Global central bankers in the world are attempting to re-stimulate and get things going. Now, at Online Trading Academy, we use the combination of macroeconomic principles and we use the principles of technical analysis to trade various asset classes, options, foreign currency, futures, specifically the E-mini. We do some partnering with the Chicago Mercantile Exchange, and, of course, equities. We also have extended learning programs where we do coaching and mentoring over the web with some of our 46 instructors on our team. For those of you that don't know about us, we started out as a day trading equity shop way back in 1997. This is our image of our trading floor. We had 180 traders who would execute about $500 million a day of trades. And we sold our floor and morphed our model into what we've become today, We now have 30 global education centers across the world in 5 countries that are prepared to serve you. We have about 143 members that use our services on a regular basis. Just go to tradingacademy.com and you'll see some free webinars. You'll see our newsletters. We regularly contribute content to multiple webinar producers across the world, and we'd certainly like the opportunity to work with you. I really enjoyed being with you today. I think we got a couple of minutes to answer questions. I'd like to leave, I think we got 3 or 4 minutes left. I'd like to answer any questions I can for you and see what I can do to help you in any way. So I want to thank you very much. You've been a very kind audience. And with that, how can I be of help to you? Boyke asked the question, what do we do with our investments? I think you all have made a great decision to be Forex traders. In times of deflation, and I believe we are going to go through periods of continued deflation, cash and cash equivalent are your best investment. Raise cash. The fastest way to raise cash is not to borrow cash. The most difficult thing to do is repay borrowed money during times of deflation. So at the end of the day, what I think you should be doing is finding assets that are overpriced, short sell them, raise cash, and then as they fall in price, buy cover, and the delta between the two is your profit. So the skill to go to cash, to own more cash and cash equivalent, get out of debt, clean up your balance sheet, I believe is the best investment, the best protection of your estate going forward. What is my prediction on gold? I believe gold will continue to be a store of value and be a flight to safety hedge, as it's played that role for several hundred years. I have no reason to doubt. Right now, the flight to safety are in U.S. Treasury bills. U.S. Treasury bills have a very, very slim yield, and as long as you see a flight to cash and cash equivalent, I expect gold to continue to be a good store of value. I think the U.S. dollar is going to, the USD, as measured by the dollar index, is going to continue to appreciate. I think there's a flight to safety and a flight to cash. I think there's the deleveraging process. With that, thank you all. God bless you. Good luck. Email me if you need anything else. Visit our website. Lots of free information there.